Your bank is lying about where money comes from. Let me ask you something. When you get a loan for a car or a house, where do you think that money comes from? You probably imagine the bank checking a giant vault, or maybe looking over their ledgers to see if they have enough of other people's savings to lend you. That's a nice story, but it's a lie. The truth is, the money for your loan doesn't come from a vault. It isn't sitting in anyone's savings account. In fact, it doesn't exist at all until the very second you sign the loan agreement. The vast majority of all money in our economy, something like 90% of it, is created out of thin air as digital numbers on a computer screen. Most of the money we use isn't printed by the government. It's created by private banks. And in this video, I'm going to show you exactly how they pull it off, why it's the biggest secret in finance, and what it means for you. We're all fed a pretty simple story about how banking works. You get paid, you deposit your money, and the bank acts as a responsible middleman, lending your savings to someone else who needs to buy a house or start a business. The bank pockets the difference in interest rates, and everyone's happy. It's a neat, tidy story that makes perfect sense, and it's completely wrong. This idea of banks as simple go-betweens is a myth. The Bank of England even published a paper to set the record straight, stating, and I'm quoting here, "The reality of how money is created today differs from the description found in some economics textbooks." They go on to clarify that bank lending creates deposits, not the other way around. So if your loan isn't coming from Sarah's retirement fund down the street, where on earth does it come from? To get the answer, we need to take a quick trip back in time to meet the original bankers, the goldsmiths. Hundreds of years ago, people traded with gold and silver, but carrying around a bunch of heavy metal was both risky and a pain. So, merchants would leave their gold with the local goldsmith, who usually had the best vault in town. In return, the goldsmith gave them a paper receipt, a promise that you could swap that piece of paper for your gold anytime. Pretty soon, people just started trading the receipts themselves. It was way easier than hauling around actual gold. These receipts became an early form of paper money, trusted because everyone knew they were as good as gold. But the goldsmiths noticed something. Only a handful of people ever came in to get their gold at the same time. Most of it just sat there. Being clever entrepreneurs, they had a brilliant idea. What if they wrote more receipts than the gold they actually had? They could lend these extra receipts out and charge interest. As long as everyone didn't show up at once asking for their gold, who would be the wiser? This was the birth of what we now call fractional reserve banking, and it's a good model for understanding the core principle, even if the real history is a bit more complex. These goldsmiths were essentially creating money out of nothing, and it worked. It helped the economy grow. But it also created a brand new risk, the bank run. If people lost confidence and all demanded their gold at once, the whole thing would collapse. That foundational secret, creating more claims to money than actual money, is the very same principle our digital banking system runs on today. It's just a whole lot more sophisticated. All right, let's get back to today. Physical cash and coins make up only a tiny fraction of money in the world. Some estimates put it at less than 10%. The other 90+% is digital, and that's the money that banks create. So let's walk through what really happens when you get that $200,000 mortgage. The moment you sign that loan agreement, the bank does something that feels like magic. It doesn't move $200,000 from anywhere. Instead, it just opens your account and types plus $200,000. That's it. Poof. New money has just been created. In accounting terms, your signed loan agreement is now an asset to the bank. It's your promise to pay them back, and that's worth $200,000. To balance their books, they simultaneously create a matching $200,000 liability for themselves, which is the new money they just deposited into your account. Your loan is their asset. Your new deposit is their liability. Their books are balanced. But in that single moment, the total amount of money in the economy just grew by $200,000. You can now go spend that digital money, and it's accepted as real because we all have faith in the system. And when you pay back your loan, the process just runs in reverse. Each time you make a payment, a portion of that digital money is effectively deleted, destroyed. The loan asset on the bank's books shrinks, and so does their liability. So think about it. Commercial banks are constantly creating money when they make loans and destroying it as those loans are paid back. Now you might be thinking, this is nuts. If banks can just type money into existence, what's stopping them from creating an infinite amount? That is the critical question, and the answer reveals the delicate and sometimes dangerous balancing act that powers our entire economy. Before we dive into that, if you're finding this as fascinating as I do, hit that subscribe button. My whole goal here is to pull back the curtain on how the world really works, and you don't want to miss what's coming next. So no, banks can't just create money infinitely. There are limits. For one, there has to be demand. People and businesses actually have to want to borrow money, but the bigger constraints are profitability and regulation. Banks are required to hold a certain amount of their own money called capital as a buffer in case loans go bad. They also have to manage their reserves, that's central bank money, to settle payments with other banks. If you take your new mortgage money and pay someone who banks elsewhere, your bank has to send real reserves to that other bank. Lend too much, too fast, and a bank can get into serious trouble. And then there's the central bank, like the Federal Reserve in the US. By setting the main interest rate, it influences how profitable it is for banks to lend. Higher rates mean slower money creation and a cooler economy. Lower rates mean faster money creation and a hotter economy. This whole system of credit creation is the engine of our economy. But it has a dark side. Because virtually all new money is created as debt, our society is built on a mountain of ever-increasing debt. This system also means that banks direct new money wherever they see the most profit, not necessarily where society needs it most. For decades, a huge portion of new bank money has flooded into real estate, pushing housing prices into the stratosphere. It also funds business investment and innovation, but the lure of asset bubbles is strong. And when banks take on too much risk, like they did before the 2008 financial crisis, the entire world can pay the price. In fact, a whole shadow banking system of less regulated firms uses similar methods to create credit, often with even more risk. Post-2008 rules have tried to add more oversight, but it's a system that's designed to operate on the edge. The secrecy around this system's origins is also revealing. The blueprint for the Federal Reserve Act of 1913 was famously hammered out in a discreet meeting on Jekyll Island, Georgia, where a handful of the most powerful financiers in America met under the cover of a duck hunt. While the final act went through extensive congressional debate, that original plan gave private banks the power to create the nation's money supply, with the central bank there to back them up. So the cash in your wallet? That's just the tip of the iceberg. The vast majority of money is just digital credit, brought into existence by a private bank the last time someone signed for a loan. Your bank isn't a warehouse for money. It's a factory for money. Once you understand this, it completely flips how you see the financial world. Money isn't a finite thing we dig out of the ground. It's a flexible, elastic system of IOUs managed for profit. It's a system that can fund incredible progress, but it also creates instability and deepens inequality. The biggest lie isn't some grand conspiracy. It's a lie of omission. We're taught to think of money in simple, physical terms because the reality is far more complex and, frankly, a little unsettling. But now, you know the truth. The next time you check your bank balance, remember what you're really looking at. Not a pile of stored cash, but a digital promise, born from debt, that keeps our entire world spinning. Let me know your thoughts down in the comments. Does knowing this change how you think about money? And don't forget to subscribe for more deep dives into the systems that shape our world. Thanks for watching.